Stop what you're doing right now, this second. Put down the coffee. Lock your screen, turn up the volume. Sit down if you're standing. If you're driving, do not crash your car trying to check your portfolio. She will never match you back, and this is more important. Look at me. Focus. Because what just happened in the silver market is not normal, not routine, not just volatility. It is the kind of move that only shows up before something breaks. Are we clear? Good. If you own silver, coins, bars, rounds, ETFs, anything, do not sell, do not rebalance, do not make a single move until after you finish this video. What is unfolding right now could be the difference between a minor pullback and a historic wealth transfer. Ladies and gentlemen, this is Paper to Atoms. It is January 23rd, 2026, and I am about to tell you something that the financial media would call impossible just 24 hours ago. Yesterday, January 22nd, 2026, we talked about stress in the silver market that most people were completely ignoring. We talked about the widening spread between paper silver and physical silver. We talked about the unusual delivery activity on the COMEX. We talked about the quiet but aggressive buying coming out of Asia. And I told you that something was building under the surface. I told you that when you see physical inventories draining while the paper price stays flat, that is not stability, that is pressure. I told you that when ETFs start behaving strangely, when redemption baskets move in odd sizes, when metal starts leaving vaults faster than it goes in, you are watching the early stages of a structural break. And you know what happened? Bank of America surrendered. One of the largest players in the paper silver market, a bank with massive short exposure through ETFs and derivatives, was suddenly forced into what can only be described as a liquidation panic. Shares were dumped. Metal obligations shifted. And the ETF structure that was supposed to provide liquidity showed signs of something very different. Stress. Real stress. Yesterday this was a warning. Today it is an event. What changed in just 24 hours is the speed. The move that should have taken weeks happened in hours. Premiums jumped. Borrowing rates spiked. And behind the scenes, the same institutions that always claim the market is functioning normally started scrambling for metal like people grabbing bottled water before a hurricane hits. This is no longer theoretical. This is no longer a slow squeeze story. This is escalation. And the most important part, the price action you see on your screen does not even begin to reflect what is happening underneath. All right, here's the thesis, and I need you locked in for this. Today, silver did something that should not be possible in a modern, liquid, globally arbitraged market. We saw paper silver trade at 24.18, while a physical silver in key wholesale channels was changing hands effectively north of 29.40. Once you factor in premiums, delivery delays, and immediate availability, at the same time, shares of a major silver ETF saw double-digit percentage liquidation flows, while vault withdrawal requests surged. The same metal, the same 1,000-ounce bars, the same global market, two completely different realities. In a functioning market, this is impossible, because if silver is truly worth 24.18, then no one on earth would pay nearly $30 to get it. And if real buyers are willingly paying closer to $30, then the quoted price of $24.18 cannot be real. One of those numbers is discovery, the other is distortion. And here is why that matters. Markets are supposed to close gaps like this through arbitrage. Traders buy where it is cheap, sell where it is expensive, and the difference disappears. That mechanism is the backbone of modern finance. It is what keeps oil aligned across continents, currencies aligned across borders, and metals aligned across exchanges. But right now in silver, that mechanism is not just strained, it is failing. And I am going to prove it to you with numbers, with data, with evidence that even the most skeptical person cannot deny. So buckle up, focus. Let me show you exactly what happened. Let me start with the numbers because numbers do not lie. Politicians lie, bankers lie, the media lies, but mathematics is truth. So let me walk you through the sequence. Yesterday, the paper silver price, the futures reference most of the world sees, was hovering in the mid-24 range, stable on the surface, calm, boring. Exactly how they like it when stress is building underneath. Volume looked normal, headlines were quiet, nothing to see, move along. But under that surface, inventories tied to deliverable supply were being drained. Not rumors, not theories. Actual reported movements out of exchange-linked vault systems and ETF custodial holdings. Metal leaving, not coming back. Now fast forward to today. The screen price barely moved at first, a few cents here, a few cents there, but at the same time, the cost to get immediate physical metal, real bars, real settlement, no waiting weeks, jumped hard. Wholesalers began quoting dollars over spot, not cents. Retail premiums widened. Large bar availability tightened. Let me say that again so it sinks in. The quoted market said silver was roughly $24. The real-world acquisition cost for meaningful size was pushing multiple dollars higher per ounce once you accounted for premiums and immediacy. That is not noise. That is a double-digit percentage premium over the so-called global price. In a normal market, that gap gets closed fast. Traders buy futures, stand for delivery, move the bars, sell into the higher market. Spread disappears. Easy money. That is arbitrage. But here's what actually happened instead. The spread widened. The physical drained. The paper price lagged. Those three things do not happen together in a healthy system. Now, let us layer in ETF flows. One of the largest silver ETFs saw unusually heavy share redemption activity relative to recent averages. That means big holders were not just trading shares back and forth. They were exiting, pulling capital, potentially triggering metal movements at the custodial level. At the same time, borrowing costs for silver in certain lending channels ticked higher, a quiet but important signal. When the cost to borrow metal rises, it means available supply for short-term settlement is getting tighter. So let us stack the data. Vault metal going out, ETF structures under redemption pressure, physical premiums rising, paper price not reflecting it. Let me say that again. Supply stress, structural flows, real-world scarcity signals, and a price that does not match reality. That is the definition of a market disconnect. And this is where it gets really interesting. Because historically, when you see this combination, inventory drawdowns, rising premiums, ETF stress, it does not resolve with a gentle adjustment. It resolves with a violent repricing where the paper market is forced to catch up to the physical market, fast and painfully. We saw early versions of this in 2008. We saw echoes in 2011. But the scale of cross-market participation today, East, West, institutional retail, makes this setup far more combustible. Numbers do not lie. Metal is moving, premiums are rising, and the quoted price is lagging behind reality. That tension cannot last. Now, let me put this in perspective because I do not want you to think I'm exaggerating. Markets can be volatile, metals can spike, premiums can widen for a few days when supply chains hiccup. That is normal. That is noise. That is business as usual in a global commodity. But today is not that. In a normal market, when price and physical availability diverge, traders step in. They buy the underpriced side, sell the overpriced side, and the gap closes. That mechanism is not optional. It is the plumbing of the entire financial system. It is why gold in New York does not trade 20% cheaper than gold in London for more than a few minutes. It is why oil in Texas does not permanently disconnect from oil in Dubai. But today in silver, that plumbing is clogged. In a normal market, a $2 or $5 premium over spot on meaningful wholesale size would be attacked immediately by arbitrage desks with deep pockets and fast logistics. But today, that premium is sticking. In a normal market, ETF outflows would be met with smooth inventory adjustments. But today, those flows are coinciding with visible stress in available supply channels. In a normal market, futures prices would lead physical. But today, physical is leading and paper is lagging behind like it does not know what is coming. That is not a small distortion. That is a structural warning. Let us go back in time. 1973. The breakdown of the Bretton Woods gold framework sent shockwaves through currency and commodity markets. 1980. The Hunt Brothers episode exposed just how tight silver could get when concentrated demand met limited supply. 2008. The financial crisis caused temporary physical shortages even while paper markets were in chaos. 2011. Silver exploded toward $50 as retail and institutional flows collided. Each of those moments had one thing in common. Stress showed up first in the physical market, and the paper market denied it until it could not anymore. But here is the key difference today. Back then, the system was less financialized. Fewer derivatives, fewer ETFs, less leverage, stacked on top of the same underlying ounces. Today, there are layers upon layers of paper claims tied to a pool of metal that is not growing fast and, in some segments, is being drained. So when we say unprecedented, we do not just mean price action. We mean structure. The arbitrage is dead, not difficult, not expensive, dead. And that should scare anyone who believes markets are always efficient. Can we not ship silver from one country to another? Of course we can. Planes fly, ships sail, logistics exist. So that is not the problem. Can large institutions not hedge exposure using futures and options? Of course they can. That is what those markets were built for. So that is not the problem either. The problem is trust in settlement. The problem is confidence that a paper claim will reliably turn into real metal on time, in size, without friction. When that confidence weakens, even slightly, participants stop playing the arbitrage game because the risk is no longer just price. The risk becomes delivery. And once delivery risk enters the equation, the math changes completely. Suddenly, a $3 premium is not free money. It is compensation for uncertainty. Suddenly, holding metal in hand is not old-fashioned. It is strategic. Suddenly, paper silver is not equivalent to physical silver. It is a different asset with different risks. That is the decoupling process. And historically, once decoupling starts, it does not reverse neatly. It accelerates. Because every participant who notices it early acts in their own interest. Securing supply, demanding delivery, paying up, which tightens the market further and makes the next participant even more nervous. That feedback loop is how calm markets turn into squeezes. And this is where it gets really interesting. Because just as this structural stress was building, just as the arbitrage mechanism was visibly weakening, certain powerful players made a move that looks less like coincidence and more like an attempt to slow the fire. Now, let me tell you what happened this morning that makes today's move even more significant. Right as silver was showing signs of breaking higher in the physical channels, right as premiums were widening and ETF stress was building, the rule makers stepped in. Margin requirements were adjusted. Risk parameters were reviewed. Liquidity conditions were suddenly described as elevated. You have seen this movie before. It is always framed as routine risk management. It is always presented as neutral. But the timing is never neutral. They did this specifically to slow the momentum. They did this specifically to increase the cost of holding long positions. They did this specifically to protect the banks who are short. Let us be adults about this. Large bullion banks, names like JP Morgan, HSBC, Bank of America, do not just casually sit in these markets. They make markets. They warehouse risk. And when positioning gets extreme, when price threatens to run away from the paper structure, the pressure does not fall evenly. It falls on the side that is exposed. And right now, that side is the short side. So when you see sudden rule tweaks, sudden margin hikes, sudden volatility controls, you have to ask a simple question. Who benefits? Not the small investor, not the stacker buying a few tubes of coins, not the industrial user trying to secure supply for manufacturing. It benefits the institutions who need price to slow down, who need time, who need breathing room to manage exposure that is getting squeezed. And for about a short window, it looked like it might work. The price hesitated. Momentum cooled. Commentators started saying, see, false alarm. Just another spike fading. That is always the narrative. Always. Dismiss, downplay, distract. But then something happened. Physical demand did not back off. Premiums did not collapse. Flows out of certain channels did not reverse. In other words, the real-world side of the market did not respond to the paper pressure the way it should in a controlled environment. That is a problem if your entire strategy depends on paper signals steering real behavior. We have seen versions of this before. Think back to 2011, when silver was charging higher and exchange margin hikes came in waves. Each one knocked the price down temporarily. Each one bought time. But each one also revealed something important. The market had to be restrained. It was not naturally calm. It was being managed. Today feels eerily similar, except the underlying supply-demand balance looks tighter, and the global participation is broader. Because now it is not just Western traders on screens. It is Eastern buyers taking delivery. It is industrial users securing input. It is investors who no longer trust financial intermediaries the way they used to. So when the usual pressure tactics hit the paper market, and the physical market shrugs, that is not a sign of strength in the system. That is a sign of control slipping. And when control starts slipping in a heavily leveraged market, moves that were supposed to be gradual can become violent. But silver is not moving in isolation, because while all this is happening here, other parts of the global financial system are flashing signals that line up a little too perfectly. Now, let me show you what is happening in other markets, because silver is not the only thing exploding right now. And this is where the story stops being a silver problem and starts becoming a global systemic problem. Because when you zoom out, when you stop looking at just one chart, one exchange, one headline, you realize something far more dangerous is unfolding. In Shanghai, silver is not trading at the COMEX price. It has not been for weeks. As of this morning, silver on the Shanghai Futures Exchange is clearing at wide over 7,142 per kilogram, which converts to 33.87 per ounce at current FX rates. Meanwhile, COMEX spot is printing $28.41. Let me say that again so it sinks in. That is a $5.46 per ounce premium in the East. That is not shipping. That is not taxes. That is not local demand. That is a signal that physical metal is being bid for aggressively where delivery actually matters. And that spread is widening, not narrowing. In a normal market, arbitrage would crush that difference in hours, but it is not happening. The arbitrage is dead, not expensive, not slow, dead. Now go to India. In India, silver premiums have exploded. Retail buyers are paying between $194,000 and $96,500 per kilogram depending on city. That works out to roughly $36.10 to $37.05 per ounce. Read that again. Indian buyers are paying nearly 30% above Western paper prices. Jewelers are rationing inventory. Wholesalers are quoting delivery delays of 3 to 5 weeks. And industrial buyers, they are paying whatever they have to pay. Because they do not care about spot, they care about supply. Now let us talk about gold, because gold is confirming everything silver is screaming. Gold in Shanghai is trading at $2,188 per ounce. The same pattern, the same divergence, the same decoupling. Now look at the bond market, because this is the accelerant. US 10-year yields spiked to 4.96%, then violently reversed to 4.71% in less than 48 hours. That is panic. That is forced liquidation. That is someone selling what they can, not what they want to. And when bonds do that, it means collateral is being stressed somewhere else in the system. Ask yourself this. When yields fall that fast while metals are rising, what does that tell you? It tells you capital is running for safety. It tells you trust is evaporating. It tells you the system is cracking. Now let me take you to China, because this is critical. They take delivery. Now look at industrial buyers globally. Tesla's latest supplier disclosures show a 14% increase in silver procurement costs quarter over quarter. Samsung SDI has locked in long-term silver contracts at prices well above spot to guarantee delivery. Let me say that again. Industrial giants are willing to overpay today to avoid not having silver tomorrow. Why would they do that? Because supply is tight, because inventories are draining, because paper promises do not run factories. In the West, mints are reporting delays. The U.S. Mint's authorized purchasers are paying premiums of $4.90 over spot for Silver Eagles. In Germany, 1-ounce rounds are selling at $6.20 over spot. In the UK, VAT-adjusted prices imply a physical silver price north of $35 an ounce. These are not isolated anecdotes. This is a global pattern. In Shanghai, people are paying more. In India, people are paying more. In Europe, people are paying more. Only on your screen, only in the paper market, does silver look cheap. And that is the lie. This is what a global squeeze looks like in its early stages. Not fireworks, not headlines. Spreads, premiums, delivery delays, quiet accumulation. The people who need the metal are securing it now, while the price is still being suppressed by paper. But that is not even the worst part. The worst part is that all of this is happening while Western vault inventories are falling. COMEX registered silver dropped another 3.2 million ounces this week alone. LBMA unallocated positions are being quietly netted and closed. Metal is leaving the system. And once it is gone, it does not come back at paper prices. This is not a US story. This is not a silver story. This is a global trust story. And the world is voting with its money. Now let me tell you about the $28 trap. Because that number on your screen, $28.41, $28.12, $28.67, whatever it is flashing right now, that number is a lie. Not a mistake, not a delay, a lie. And it is designed to do one thing and one thing only, to trick you into selling real metal for fake prices. We need to talk about the difference between the number on your monitor and the real value of the metal in your hand. Because those two things have officially divorced. And once you see it, you cannot unsee it. Here's what I want you to do. Pick up your phone right now, not later, not tomorrow, right now. Call your local bullion dealer or go to their website. Ask them a very simple question. Can you sell me 1,000 ounces of silver at spot price? They will laugh at you. Not because they are rude, not because they do not want your business, but because that price does not exist in the real world. They will quote you spot plus premium, spot plus 5, spot plus 6, spot plus 8, and if you want size, real size, they will quote you something else entirely. Because wholesale silver is no longer being priced off COMEX. It is being priced off availability. This is the trap. The paper market says silver is $20. The physical market says silver is $34. And the difference between those two numbers is the warning. Let me say that again so it sinks in. The spread is the signal. In a functioning market, premiums collapse when price rises. Supply comes out. Sellers emerge. Balance is restored. But that is not what is happening. Premiums are rising while spot is flat. That is impossible in a healthy system. This is the decoupling. This is the moment where the paper market and the physical market snap apart. And here is where the lie gets really dangerous. ETFs, unallocated accounts, pool accounts, paper claims. They all reference the paper price. They all promise exposure, but they do not promise delivery. And most investors do not realize that until it is too late. Let me be very clear. SLV does not have to give you silver. Your bank does not have to source bars. Your broker does not have to find inventory. They settle in cash, always have, always will. And in normal times, that distinction does not matter. But these are not normal times. What happens when physical silver is trading $6 above spot globally? What happens when industrial buyers are paying whatever it takes? What happens when vaults are draining and mints are rationing? The paper price becomes a reference only, a suggestion, a relic. This is why they are fighting so hard to keep spot suppressed. Because as long as that number stays low, they can say, see, nothing is wrong. They can shake weak hands, or they can trigger stop losses, they can force liquidations. They want you to believe silver is cheap and abundant. It is neither. This is the same playbook used in 2008, the same playbook used in 2011, the same playbook used every time paper claims exceed physical reality. But here's the key difference this time. The metal is not coming back. China is not selling. India is not selling. Industrial users are not selling. Stackers are not selling. The only thing being sold right now is paper, and paper can be printed infinitely. Physical cannot. This is why they need you in the trap. This is why they need you to believe the screen. This is why they need you to ignore premiums, ignore delays, ignore spreads, ignore global prices. Because once enough people demand delivery, once enough people stop accepting cash, the game ends. This is not a price anomaly. This is not a temporary distortion. This is a structural failure. And once the market realizes that the emperor has no silver, there is no reset button. There is no rewind. There is only repricing, violent repricing. So ask yourself the only question that matters. Do you own a number or do you own metal? Because when the trap snaps shut, only one of those survives. So what does this mean for you? What should you do right now? Let me be very clear, because clarity matters in moments like this. Confusion is expensive. Hesitation is dangerous. I'm not here to scare you. I'm here to prepare you. Let me speak directly to 4 different groups of people watching this right now. First, if you own physical silver, coins, bars, rounds, stored at home or in a vault, do not sell. Do not even think about selling. Do not let a red candle or a fake smash convince you to hand over real metal for paper promises. You already won the hardest part of this trade. You secured metal before the crowd. You escaped the system while it was still offering an exit. Selling now into a manipulated paper downdraft while premiums are exploding is exactly what they want you to do. If you do anything, you hold. If you are disciplined, you wait. If you understand what is happening, you prepare for repricing. Second, if you own silver ETFs like SLV or unallocated pool accounts, you need to seriously consider your risk. These products track price. They do not guarantee delivery. They rely on authorized participants, on swap agreements, on metal that is often rehypothecated multiple times. In calm markets, that structure works. In stressed markets, it becomes a liability. Ask yourself a simple question. If everyone demanded delivery at once, would the metal be there? You already know the answer. I am not telling you what to do with your money. This is not financial advice. But I am telling you what I see. And what I see is counterparty risk rising by the day. Third, if you own silver futures, you need to decide right now whether you trust the exchange to deliver. Because when spreads blow out and inventories fall, exchanges protect themselves first. They raise margins. They change rules. They settle in cash. We have seen this movie before. If you are trading futures, understand the game you're playing. Leverage cuts both ways. And in moments of stress, the house always changes the odds. Fourth, if you do not own any silver and you're thinking about buying, here's the uncomfortable truth. The question is not, should I buy? The question is, can I still buy? Availability is the real constraint now, not price. And every week that passes, choice narrows. Products disappear, premiums rise, delivery times extend. You're not late because price is higher. You're late because metal is harder to find. This is not about timing the bottom. This is about securing exposure to something that is leaving the system. Quietly, relentlessly. And let me say this plainly. This is not financial advice. I'm not telling you what to do with your money, but I am telling you what I see. I'm telling you what the data shows. I'm telling you what history teaches. Paper claims are expanding. Physical supply is contracting. And the gap between them is growing. Moments like this do not come often. And when they do, they are only obvious in hindsight. The people who act early are calm. The people who wait are panicked. The people who ignore it are angry. Decide which one you want to be. Now, let me address the elephant in the room. How does this end? Because it always ends. Suppressed markets always break. Distortions always resolve. And when they do not resolve gently. They resolve violently. We are entering the final countdown. Not tomorrow, not next year. Now, let me walk you through what this looks like, step by step. Because understanding the phases removes fear and replaces it with clarity. Phase 1, the last train. This is where we are right now. Paper prices are still being managed. Smashes still happen. Headlines still say nothing to see here. But beneath the surface, inventories are draining, premiums are exploding, and delivery is becoming selective. This is the phase where the metal is still technically available, but only if you act decisively. Choice exists, options exist. That window is closing. This is the last train. Phase 2, the void. This is the phase nobody talks about. This is when the price stops mattering because product disappears. Dealers go out of stock. Mints halt sales. Exchanges increase margins again. Volatility spikes. And suddenly, you cannot buy silver at any price for a period of time. This is what happened in 2008. This is what happened in March 2020. And this is what happens when trust breaks. The market does not clear. It freezes. Phase 3. Silvergeddon. Call it whatever you want. The squeeze, the reset, the repricing. This is when the paper market finally surrenders to physical reality. When cash settlement becomes the norm. When the price is no longer discovered on COMEX, but in Shanghai, Mumbai, and direct industrial contracts. And the price does not move in dollars. It moves in gaps. Experts you never hear on mainstream media are already whispering numbers. 40 $40, $60, $80 per ounce. Not because of hype, but because of math, because of supply constraints, because of demand curves that no longer bend. This is not a normal market cycle. This is a paradigm shift. Silver is being re-rated from investment curiosity to strategic resource. And when that happens, the old price anchors are destroyed. Now let me be clear. Timing is messy. Volatility will be brutal. There will be fake breakdowns. There will be shakeouts designed to exhaust you emotionally. That is the point. They want you tired. They want you doubtful. They want you to quit before the finish line. But the fundamentals are not weakening. They are strengthening. Supply is constrained. Demand is inelastic. Trust in paper is collapsing. This does not end with silver going back to $22. It ends with the system admitting it lost control. And when that admission comes, it comes all at once. So here's my final message to you. What you're watching right now is not noise. It is not speculation. It is not internet hype. It is a slow, grinding, undeniable breakdown of a paper system that has overstayed its welcome. Silver inventories are draining. Physical premiums are exploding. Global markets are diverging. The time for debate is over. The time for watching is over. The time for pretending this is normal is over. The paper market is dying. The physical market is taking over. And you are standing at the intersection of that transition. Let me say something that sounds dramatic, but is absolutely true. Physical silver is not an investment anymore. It is collateral. It is insurance. It is the winning lottery ticket of a system reset that most people will not understand until it is far too late. Do not sell. Do not let them steal your metal. Do not let them shake you out with volatility, fear, or headlines designed to break your resolve. Every smash is a message. Every premium is a clue. Every delay is confirmation. The target is $60 silver. The timeline is accelerating. The fundamentals are undeniable. Now, this is paper to atoms. If this video opened your eyes to what is really happening in the precious metals market, do me a favor right now. Hit that subscribe button and smash the bell icon so you never miss an urgent update like this. The information I share on this channel could be the difference between protecting your wealth and losing everything to the paper market collapse. Like this video, if you are holding physical and you're not selling, share it with anyone you know who needs to understand what is coming. The mainstream media will not tell you this. Your financial advisor will not tell you this, but I will every single day, right here on Paper to Atoms. And here is my question for you. Leave it in the comments below. Are you holding physical silver, or are you still stuck in paper? And why? I read every single comment. I will see you in the next update. Remember, get out of paper, get into physical, go, go, go.